What's up guys, it's Zeb. This bear is official till date. The market just hit a brand new low and high. People believe that the economy is about fall even more for Michael, for example. Barry went on record to say just that. SP 500 still has a lot of room. Dr. Dom, economist, believes that we are a long and ugly recession and global economy continues. After all, on the edge of historical change, Goldman Sachs predicts that China will 2023 sees zero growth in interest rates. A huge increase is expected. And even the Federal Reserve predicted unemployment is rising out of its way, destroying unsustainable price increases. So after watching Andre Dick's video going over his thoughts on a potential depression makes me want to throw up. Mix ideas, because there is one proven way to invest and profit. A market that seemingly does nothing but fall and fall and fall and fall and again. I will share how I plan to invest your money over the next year, because I'm saving cash for it. An investment in particular that I seems to work incredibly well though. Before we go into details about it, you can make money. We had to do before talk about if you could subscribe. Thank you if you haven't already. People, in a lot of terms, how badly our economy is collapsing. And here's why it's likely to get worse. What you need to know at the most basic. Match everything to our price. The value of our investment in money, the momentum of the entire economy. An increase in employment leads to demand and profits. Determined by the two-word interest rate. Without getting too complicated, it is the rate of interest fixed by the Federal Reserve determines how much banks pay other banks each time lend money to each other, and in return, there is an indirect effect on rates, being presented in everything from personal loans, mortgages, or credit cards, practically anything where there is money borrowed from one person to another. Because of this, when the interest rate borrowing less money and cheaper for people spend more of it, but when the interest rate both people and business are superior, back and forth as demand slows down. What is happening here as a result? Only this year more mortgages are now almost twice as expensive as every stock. The index has fallen by 20%, and that warn that investors will suffer some pain while the economy is stagnant. Although in this case it is not the only one. The United States is the whole world. The development forecast has started dramatically decreased. Sensation that people are not spending like that anymore, as their high prices start to eliminate discretion spending, and it's almost affecting every business there is. For FedEx, a well-known example is called indicators, because when they have less, the ship is a sign that other businesses looking at the decline in volume suggests that there is a global recession around the corner. But now that's Pandora. The box has already been opened. Talk about how it is likely to be affected. You own your investment and your money. First, we should talk about stocks market. As a result of high rate, low discretionary consumer spending and slow growth rates are considered. He fell from his peak at this point. Most people would compare 10 years Treasure with SP 500 as the interest rate appears. The stock market started going down. After that it started to magically get high, trading for almost 2 decades. But in reality, most of the analysts are saying, for what is called earning a recession will underreport companies, meanwhile, higher than expected profits. In terms of how big the next few years are now, we can see Goldman Sachs on the downside. He takes the approach that usually endures. Markets fall by about 30%. Combined with the recession, we mean there are 10 more to fall if they are also fix the black rock mirror, considering their views slow down in consumer demand. Prolonged eating will lead to new deficiencies, but within the bigger picture as an earnings recession, what exactly is the Federal Reserve aim for? Because with less expense, less demand, and lower prices come hence low inflation. Second, see housing market. Stock contrasted with home prices do not fluctuate from moment to moment. Depends on what Jerome Powell said. This one because of him during a speech, much like moving a ship we are doing. Do not turn the steering wheel. An immediate effect, but it sets a new speed course that just over time it becomes apparent in. It's starting to happen here. The latest speech, Jerome Powell warned the housing market may be moving towards an improvement of 10 to 20%. And in his words, that is what we need to better match supply and demand, so that house prices increase the right level at the right price. And people can now buy houses again, although I have cited statistics. First, about the low decline in home sales inventory and record prices that they have. Finally, the bottom began to decline in August, about 6% to their peak in June. This is mostly the result of high mortgage rates are pushing down affordability and what impresses buyers now ready to pay for the house. Thankfully, it doesn't look like a housing reform will happen anywhere close to what we saw in 2008, but many markets are seeing declines. Up to 10% and overall is likely to translate into more affordable prices. Speaking par for the course for buyers because prices are still 40%. They were higher than 2 years ago. Then thirdly, we have bonds, don't we? Bond that bond, and there's more. Our troubles are beginning, and for them. An uninformed bond is basically a method. Lending money and paying with it. A fixed amount of interest and according to the right. Now if you go and buy the treasure, the bond is fully backed by the US Fed government. They are paying you. If you have a 4% return guarantee, keep it for a year. Now think about it. If you are an investor and you want, why would you make money in the markets? Take the risk of investing in stocks, cryptocurrency or real estate when you risk-free 4.1 can get returns for. Doing absolutely nothing is reality. A higher bond return means less money flows into other investable assets, and which in turn brings prices down. Everything else, not to mention further increase in interest rates. It is possible to offer bonds even more return than what they are paying. It is still too early. Tell them where they can come down, and after all, we now have a strangely enough amount of money. This one is a bit more controversial, because if one holds cash, they are losing value to inflation. However, if they are not catching anyone, cash that puts them in limbo position, their investment fall. They lose their jobs and need it to fall behind because of something that I think should be treated as cash. It is like any other investment. Enough on the edge to cover 3-6 months worth of increases in your expenses. A bit more as a buffer. Anything unexpected comes now and then. Want a little extra for sprinkles? You should get some extra peace of mind. It is needed, though. In terms of markets are the future for you. And how I'm personally doing my investing. Here's what you need to know about money, because it can be easily avoided. Reasons to get the average investor. Such a terrible comeback, though. Before we go into this real conversation, I understand how frustrating it can be as one investors in 2022. So when this then comes the investment, some years it is remarkable how terrible is the average investor. That way you don't make the same mistakes. See, a friend of mine runs a blog, Market Sentiment, at the link below, in detail, because they found that the average investor over 30 years makes only 1/10 of the return. The market as a whole is not real. The time period over which the average the investor hits or even matches the highest. Why you can do market fundamental returns? Ask. Well, is the tendency of most investors selling at the worst possible time, and the aftermarket is already buying, but generally saw an upward trend. Fear of losing them in doing so. Basically sell down and buy up. The peak thus reduces the total return. Apart from this, he also mentioned a good thing. Point out that there is an element of luck that determines your success. After all, 10 years period. If you started, you will invest in the year 2000, while a decade later they have lost money. If you started in 2010, you would have more than double your money. The solution in this scenario is to have a balanced portfolio of bonds, which is generally very stable and powerful. Even a price increase over a period of time that the stock declines to do so. Mentioned a balanced portfolio. Positive returns 60% of the time, and even when the market went down. Keep in mind that damage is minimized, that nothing is without danger, and even 2022 bonds are looking at one of the worst in terms of how every year in history. It can last for a long time. Accordingly, Michael Berry is not falling inflation, monetary policy outcome, and politics, and it's just not going away. Be the same spike as he describes it. Inflation will come down. People celebrate by spending more money, and then inflation will reappear. Sometimes for a decade. Conditions for the right way to invest. The strategy involves dip buying. Average results in about twice the return of someone who only holds and does nothing. I also found it interesting that average takes 1 to 2 in the markets. A year down and 2.5 years Allows continuous purchases so as to restore to buy you lows while getting. The upside is that things will eventually happen back to normal except for everyone. Studies show that the more you invest, to reduce your chances of losing money with a 99.8 probability of a balanced portfolio is more profitable. A 15-year time frame though in terms how have I been investing all this time? Next year is my whole plan first. Let's talk about the last few stocks. Over the years I have been dollar cost averaging in the SP 500 index fund and international index fund each a day without fail though I am not. I'm throwing all my money here, investing exactly the same amount on a regular basis and not expected. I am a firm believer. The stock market over the next few decades and whatever happens between now and then. Then the only white noise is the other us. Let's talk about real estate. 2020 real estate was my biggest holding, and that was where almost all my money was. Investments were made, but as I began to gain busy, real estate took a bit of a back seat. During the session I focused on my balance portfolios in other asset classes. But now I see a lot of potential coming up with commercial real estate. Like medical office buildings, warehouses, space, or long-term high-end tenants, and
I'm just saving up and waiting for it. Here is the right opportunity to come.
My thinking so far is commercial realism. The estate is barely affected. The market after most buyers purchase a cash flow based property, not gross market conditions. If a building is constructed, $50,000 a year, and that if you sell it, you get 5% return. $1 million worth, and this is just one. It's only a matter of time until buyers stop taking loans to buy at 6% property, which constitutes only 4%. I just don't think it's sustainable anymore. The only logical solution I could see.
This is the return of commercial real estate. Must be reduced and increased.
Purchase price if it's just confusing. Imagine a building worth $50,000. $1 a year is worth $1 million and 5% return, but now that interest rate has gone 3 to 6% is exactly that. The building may have to be sold for 6 and 1.5% return. That will be the price of which is $770,000 is why I'm taking it. A really close look at commercial real estate, a property that I can buy for cash. That way I can take advantage without soft market conditions. Worry about paying more interest or competing with other buyers who carry out debt just for the sake of affordability borrowing. Because of this third, I'm keeping a little more cash until I get it right. I want to be now to buy property. Completely transparent that I still am. I invest exactly the same amount the stock market as I have been throughout
these last few years, but everything goes in extra cash and whenever is good.
The deal comes, I'm buying it. I don't have it. When do you think it could be? A week, a month, or a year from now? But me don't think about commercial real estate. These rate hikes are still fully priced, and it's a chance that I am. Overall, I am watching very closely. This year is probably going to say being difficult enough for most investors, and in a way that is to be expected. Investments don't just keep going upward indefinitely and going there. This is one of the years where you lose money. Part of the process, but don't let it happen.
You should stop, and if anything happens, it's encouraging to know that you can buy everything cheaper than today. You may have a year ago, I know it is. Losing money or watching you is never fun. Depreciation of investment, but it is a. Be sure to play for a very long time. You have plenty of money to look at. Continue investing in yourself. Hit the like button as normal and usual. For the YouTube algorithm if you haven't. You said you already did. Thank you so much for watching, friends, always.